The S&P 500 dropped 0.5% this week. NVIDIA fell over 6%. Novo Nordisk lost 21% in 5 trading days. But here is what most channels will not tell you. The equal weight S&P 500 actually rose. Financials climbed, energy climbed, industrial stocks climbed. This was not a market crash, this was a rotation. And rotations create opportunity for owners who understand what they hold. Today, I am breaking down exactly where the money moved, why it moved, and what it means for your retirement portfolio. Stay with me. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here is what we are covering. First, the full index breakdown and where sectors landed. Second, the biggest winners and losers in the S&P 500 and why they moved. Third, what January inflation data means for the Fed and your money. Fourth, global forces reshaping commodity prices right now. Fifth, how our portfolio companies performed through all of this. And sixth, what to watch next week. Start with the scoreboard. The SPY, which tracks roughly 500 of the largest publicly traded U.S. companies weighted by market cap, closed at 685.99. That is a loss of 0.48% for the week, but still positive 0.60 on the year. The heavy mega-cap technology weightings dragged this index lower. Investors locked in profits across large-cap tech names. Now compare that to the RSP. The equal weight version of the same 500 companies rose 0.43%. That positive return signals broad participation from non-technology sectors. When the equal weight index beats the cap weight index, it means the average company is doing fine. The pain was concentrated in the biggest names. QQQ, the Nasdaq 100, slipped 0.25%. Profit-taking in semiconductor stocks drove that decline. Year to date, it sits at negative 0.50. Small caps got hit hardest. The IWM tracking 2,000 small cap stocks fell 1.21%. Rising bond yields pressured smaller companies that carry heavier debt loads. Higher borrowing costs eat directly into their margins. The sector numbers tell a clear story about where capital flowed this week. Energy led. The XLE closed at 88.0, up 1.2% for the week and 3.1% on the year. Energy producers climbed alongside rising crude oil prices following supply constraints in the Middle East. We will get to those constraints in the global section. Financials followed. The XLF ended at 51.43, advancing 1.1%. Commercial banks reported expanding net interest margins after the latest inflation data release. When inflation runs hot, banks make more on the spread between what they pay depositors and what they charge borrowers. Technology fell the hardest. XLK dropped 1.8% to close at 205.10. Hardware suppliers experienced sharp sell-offs after several component makers issued cautious revenue guidance. This sector is now negative 0.50% on the year. The pattern is straightforward. Money moved out of expensive growth and into cash-generating cyclicals. That is a rational response to sticky inflation data. The weekly winners reinforce this rotation theme. GE Aerospace led the entire S&P 500, climbing 8.5% to close at 150.20. The aerospace division secured major new contracts from global airlines. Year to date, the stock is up over 14%. Real demand for physical products from companies spending real capital. JP Morgan Chase rose 6.2% to 205.10. Executives revised net interest income projections higher during an industry conference. When the biggest bank in America tells you interest income is rising, pay attention. That is 9.1% year to date. S&P Global gained 5.84%. Corporate debt issuance volumes rebounded sharply in February. This company operates in a ratings oligopoly. When companies need to borrow, they need a rating from one of 2 or 3 firms. That is a toll booth on global capital markets. ExxonMobil rose 5.4% as crude prices rallied on global supply constraints. 6.8% year to date. Eli Lilly advanced 4.21% after positive clinical trial data for a next-generation oral metabolic compound. The stock sits at 1,051.99. Notice the pattern: aerospace, banking, ratings, energy, pharma. Not a single pure-play software company in the top 5. The losers column tells the other half of the story. Palo Alto Networks dropped 15.4% to 285.40. Management lowered annual billings guidance. Businesses are spending less on software. When the cybersecurity leader cuts guidance, that signals real tightening in enterprise tech budgets. Moderna fell 11.2%. Their experimental respiratory vaccine showed lower efficacy than competing products already on the market. The stock is down over 18% year to date. Snowflake lost 9.5%. Revenue growth decelerated as large enterprise customers reduced cloud computing consumption. Cloud was supposed to be recession-proof. It is not. Albemarle dropped 8.8%. Global lithium carbonate prices slid further amid oversupply from Chinese producers. This stock is down over 22% on the year. NVIDIA fell 6.65% to 177.19. Aggressive profit-taking hit semiconductor names after rapid price appreciation. The stock is down nearly 5% on the year. These price movements confirm a shift in risk appetite. Institutional buyers reallocated capital away from highly valued software and hardware vendors into cash-generating industrial and energy assets. 2 economic reports dropped this week that matter for your portfolio. The Bureau of Economic Analysis released the January Personal Consumption Expenditures Price Index. This is the Fed's preferred inflation measure. Core PCE increased 0.4% month over month. That exceeded the consensus estimate. Services inflation, driven by housing and transportation costs, keeps pushing the index higher. Consumer spending remains strong enough to support economic expansion while keeping pricing pressure elevated. Translation: Americans are still spending, and prices are still rising. The Fed has no reason to rush a rate cut. Second, December construction spending rose 0.3% month over month. Manufacturing facility investments drove that number. Companies are building factories on U.S. soil. That reflects real corporate confidence in the domestic economy. These are long-cycle capital commitments. You do not break ground on a factory if you expect a recession next quarter. The Federal Reserve made its position clear this week. New York Fed President John Williams explicitly stated the central bank requires months of convincing data before considering a reduction in the federal funds rate. Not weeks, months. Interest rate futures markets adjusted immediately. Traders pushed the probability of a first rate cut into the second half of the year. If you were counting on rate cuts in March or April, that expectation is gone. The yield on the 10-year U.S. Treasury note climbed to 4.25%. Rising discount rates directly compress the valuation multiples of high-growth, long-duration equities. That is exactly why NVIDIA and Snowflake and Palo Alto got hit. When the risk-free rate rises, the present value of future cash flows drops. Growth stocks carry the longest duration. On the funding side, the U.S. Treasury auctioned $211 billion of Treasury notes this week. Solid institutional demand absorbed the supply without disruption. The bond market is functioning. That is a good sign. 3 global forces are shaping commodity prices and supply chains right now. First, ongoing disruptions in the Red Sea are forcing global shipping firms to reroute vessels around the Cape of Good Hope. Spot freight rates from Asia to the U.S. East Coast stabilized at elevated levels. Prolonged transit times act as a tax on goods-producing companies that depend on global supply chains. Every extra week at sea costs money. Second, Chinese policymakers mandated production cuts at several major copper smelters to support domestic margins. Global copper prices rallied immediately. The materials and mining sectors in the U.S. received a sympathetic bid. Industrial metals demand functions as a reliable leading indicator for global manufacturing health. When copper moves, pay attention. Third, Brent crude oil closed at $82.50, up 2.1% for the week and 5.4% year to date. Escalating shipping disruptions tighten short-term global energy supplies. That supports the energy sector rotation we discussed earlier. Quick note before we get to the portfolio review. If you are serious about compounding your retirement for the long term, finding companies that double their share price every 3 to 5 years, and learning why investing in shares of great businesses with aligned management teams lowers your monitoring costs and allows for long holding periods, we offer a free review of your 401k choices. The link is in the description and the pinned comment. We will look at what you own, what it costs, and whether your current holdings match your retirement timeline. No obligation, no sales pitch, just a straightforward review. 3 catalysts to watch next week. Monday, the Institute for Supply Management releases the Manufacturing Purchasing Managers Index. A reading above 50 confirms that the industrial sector is expanding. Midweek, Federal Reserve Chairman Jerome Powell delivers his semi-annual monetary policy testimony before Congress. Markets will parse his prepared remarks for any shifts in language about the balance sheet runoff pace. Friday, the Bureau of Labor Statistics publishes the February non-farm payrolls report. Investors need visibility into wage growth to assess future inflation risks. The bull case requires cooling wage growth in the employment report and a measured tone from Powell. Data that aligns with a gradual softening of the economy would support equity markets. The bear case involves a hot payrolls print and a hawkish pivot from Powell. Accelerating job growth alongside sticky services, inflation guarantees further multiple compression in highly valued technology and consumer discretionary stocks. Sectors to watch: XLE at 88.0, highly sensitive to global supply constraints. Apple at 264.18, sitting at a critical technical level ahead of new product announcements expected next month. Now let us look at how our portfolio companies performed. S&P Global, ticker SPGI, led our portfolio, up 5.84% to close at 441.8. Corporate debt issuance volumes rebounded sharply in February. CEO Douglas Peterson confirmed during an investor presentation that institutional clients are aggressively adopting their new benchmark analytics. This company provides credit ratings, benchmarks, and analytics to global capital markets. It generates highly recurring subscription and transaction-based revenues. The ratings business is an oligopoly. That moat does not erode. Copart, ticker CPRT, rose 4.41% to 38.09. Used car pricing data showed stabilization, while salvage values increased. Co-CEO Jeff Liaw noted that total loss frequency continues to climb as repair costs for complex vehicles outpace actual cash values. Copart operates online salvage vehicle auctions. It runs an effective duopoly with massive physical land assets. That insulates the business from software volatility. Kinsale Capital, ticker KNSL, gained 4.35% to 389.67. The company reported continued premium growth and a combined ratio well below the industry average. Management maintained underwriting discipline while capitalizing on competitors exiting volatile markets. The board declared a cash dividend of 25 cents per share. Eli Lilly, ticker LLY, advanced 4.21%. Positive clinical trial data for a next-generation oral metabolic compound. CEO David Ricks stated they are expanding manufacturing capacity rapidly to meet patient demand. Inelastic healthcare spending shields this company from interest rate pressure. Roper Technologies, ticker ROP, rose 4.15% to 349.73. A 98% gross retention rate across its software-as-a-service segments. Consistent recurring revenue shields the firm from macroeconomic volatility. Capital allocators rotated into Roper this week seeking predictable cash flow. Not everything moved in our favor this week. Transparency matters, so let us walk through the other side. Novo Nordisk, ticker NVO, was the hardest hit, down 21% to close at 37.45. Manufacturing bottlenecks at a primary contract manufacturer delayed revenue recognition for their flagship weight loss treatments. CEO Lars Fruergaard Jorgensen stated they are reallocating manufacturing capacity to meet existing patient requirements. Short-term supply chain constraints obscure the large, uninterrupted global demand for their therapeutics. The demand has not disappeared. The factory has a bottleneck. NVIDIA, ticker NVIDIA, fell 6.65% to 177.19. Aggressive profit-taking hit semiconductor names. CFO Colette Kress explained that cloud providers require time to deploy their current server allocations before ordering more chips. The price action represents a valuation reset while the underlying business execution remains solid. Broadcom, ticker AVGO, dropped 3.9% to 319.55. Investors expressed impatience with the timeline for margin expansion on recent enterprise software acquisitions. Prices moved in tandem with NVIDIA. Core dividend distributions and recurring software revenues provide a solid financial foundation for long-term owners. General Motors, ticker GM, fell 3.44% to 78.71. Slower EV adoption metrics, rising interest rates pressuring auto loan affordability, and escalating union labor costs compressed projected margins. Free cash flow from internal combustion trucks provides a margin of safety during this transition period. Accenture, ticker ACN, declined 3.8% to 208.72. Enterprise customers delayed consulting engagements into the second half of the year. North American clients paused signing large contracts amid macroeconomic uncertainty. Leadership has navigated multiple corporate spending downturns successfully in the past. Step back and look at the full picture. The portfolio this week reflects a classic mid-cycle rotation. High multiple holdings like NVIDIA and Novo Nordisk experienced severe short-term volatility from sector rotation and specific supply chain news. Holdings like S&P Global and Copart demonstrated resilience. Cash generation across these businesses remains firmly intact. Risk sentiment shifted away from high multiple growth toward predictable cash flow generators. Short-term noise frequently dictates weekly price movements. Long-term value creation depends entirely on business execution. I was reviewing a client portfolio last week that held many of these same names. The client asked whether the NVIDIA decline meant something was broken. It did not. The company's data center revenue continues to grow. The stock price corrected because the market was paying for perfection, and perfection is a hard standard to maintain quarter after quarter. Disciplined owners should stay aligned with their company's underlying financial performance. 3 principles from this week that apply to every week. First, pricing power wins. The January PCE data confirmed the Fed cannot cut rates as aggressively as the market previously expected. Businesses with pricing power will outpace those that depend on cheap borrowing to fund operations. Ask yourself, can the companies you own raise prices without losing customers? If the answer is yes, you own the right businesses. Second, prices run ahead of reality. Strong earnings and operational updates do not guarantee stock price appreciation. When a sector prices in flawless execution, minor supply chain delays trigger rapid sell-offs as institutions rebalance. The severe reaction in the pharmaceutical and semiconductor spaces this week proves that market prices often run ahead of business realities. Third, quality absorbs shocks. Companies generating large free cash flows possess the internal strength to handle higher interest rates and supply chain frictions without permanently impairing shareholder capital. That is why we own what we own. Review your financial plan with an advisor to ensure your liquidity needs are met. Keep your attention on the compounding value of your underlying businesses. If this breakdown of the sector rotation helped you understand what is happening with your money, you'll want to see this video, where I explain exactly how we identify owner-aligned companies that compound wealth through full market cycles. That is the foundation of everything we do at VAP. I will see you there.